Welcome back. Time now for some primary market action. The 1,170 crore public offering of a third-party insurance administrator, Medi opens for subscription today. The price band has been set at 397 to 418 rupees per share, and this is a pure offer for sale. And just a quick word on the company. This is a third-party insurance administrator, TPA as it's called. It acts as a link between the insurer, the healthcare provider, that's your hospital, and the policy holders. The TPAs will facilitate the claims settlement process. They're licensed by the IRDA, and Medi, remember, provides only health insurance, not life. They get paid by the insurance company, and Medi is one of the larger players in the market with a near 20% market share. To talk more about their plans, the business prospect, we have with us Satish, Gidugu, the Chief Executive Officer and the whole-time Director at Medi on the show now. Quickly, just in 2 lines or in 2 minutes, tell us a little bit about the business model and why is this a sustainable, profitable business model going ahead?
Thank you. First of all, good morning and festive greetings. Thank you for having me here. So as within Medi, most of our revenues, 93% of our revenues come from the third-party administration business that we deliver in India. We are a regulated intermediary that's regulated to work with health insurance companies in delivering services to policyholders that buy health insurance. So that's, in a nutshell, is what our mandate is.
So talk about, when I look at your H1 revenues, your profits stand at 22.4 crore versus 36.6 crore year on year. Why has there been a drop in profits?
So if you looked at the RHP, we've explained that on page 309 and 310 because it's an often used asked question. So our adjusted PAT is 45 crores for H1. There is an item related to selling shareholders due to accounting reasons passing through the company's P&L, but there is no net impact to the company itself.
Okay, so it's a one-off.
It's not even a one-off, it's just passing through the company's P&L only for the accounting reasons and it's with no cash impact or no profit impact on the company.
Okay.
But since you spoke of the RHP, Satish, there was one point that highlights in it that it says that 78% of your revenue for FY23 comes from its from your top 5 clients.
True.
Is that a reason to worry? Because client concentration is always a risk for the business, because if something adverse happens to any one of the clients, your business is impacted. So do you plan on bringing that share down and you look at increasing your revenue from your other clients just so that that number comes down from 78%?
So we reasonably mimic, if I were to just take a step back, and if within the health insurance, there are 3 segments. There is group, there is retail, and there is government. And within each segment, we reasonably mimic the distribution of how the business is. Right? Group is where we make most of our revenues. In group, there's a certain concentration we mimic. Retail is a relatively new piece for us, reaching out to about 12% of our revenues. There, it's a 50-50 concentration between public and private sector insurers. There are also non-premium generating revenues, which are not dependent on the clients. For example, our international revenues that come from Mayfair, or the government business that's not backed by insurer. So that's a number that's continuously growing. And in fact, as of September 30th, the top 5 is at about 71%.
Oh, so it's at 70. So it's come down anyway. So do you intend to bring that down further as you go?
I think we'll reasonably mimic how the market dynamics are in terms of how customers are changing their preferences of who they work with the insurance companies. Right. We work with almost all of them.
Okay. Your margins have been stable between 23 to 24%. I think one question people had is that you derive a fee or a yield from the insurance companies, which is a percentage of the overall premiums that you manage. Now, given the competition, is there a risk that that yield will come down? And therefore, is there a risk to your margins? Will the margins be able to sustain at these levels?
I think there are 2 parts to the margin. One is how we get remunerated from the top line perspective. The remuneration is best understood as by product. Each insurance company has different kinds of products that they sell. Some are high intensity from a workload perspective, some are low intensity. Typically, our remuneration is more a product-driven construct, not a relationship-based construct, right?
But market dynamics, competition must affect, right?
So far, fortunately, the price has not been the reason for customers to switch, given the intensity of the service that we deliver. Typically, the yield ranges on group products and retail products have been stable. It's more the mix that you see in our business that drives the yield.
Okay, so margin should be stable.
We've been for the last 4 years, especially if you looked at how post-COVID, the claim volumes have nearly doubled. We've been able to manage that whole growth and expansion. So it's a combination not just of stable revenues.
Just
so it's
one
also
quick
the
question
efficiency.
then. You're saying that pricing is not a reason why, insurance companies may switch from one TPA to another. Then what is it? In the past, in the last 3 years, when you've lost out on any, insurance company as your client, what has been the reason?
So fortunately, we've not lost out on insurance companies as clients.
Okay.
We've only added. We work with 27 out of the 28 insurance companies today, and we've been adding. Of course, the policyholder, because these are annual policies, has a choice to change insurance company, agents, brokers, TPAs once a year.
Okay.
And it's an annual retention business, and we still retain over 94% in our group business and continue to add more in the retail business.
IT and BFSI are your top clients.
Yes.
Almost 70 to 75% of your top line comes from these two segments. Do you plan on going beyond these two segments? Are you in talks with clients beyond these two sectors that can expand your reach other than these two?
See, historically, BFSI and ITITS have been the most benevolent in terms of employee benefits and the size of the ticket size of the benefits, and clearly, and their largest headcounts today sit there. It's also a reflection of where the organized employment today is from a benefits perspective. So clearly, if you look at, we have 9,500 corporates as of March 31st. ITITS is about 68, 67%, and that's where it has stabilized. And I think as the other industries mature and improve the benefits, it will automatically change.
Okay. Your market share has been going up, and I think it currently stands at 20%. What about the market share of peers? Have you been growing market share at the expense of competitors like Vidal Health Insurance, MD India Health Insurance, Family Health Plan Insurance? Or is it just because the market itself is getting more organized and moving towards TPAs that your market share has gone up?
So multiple factors. One, naturally, there's been a consolidation from 31 odd TPAs 10 years ago. We are about 50% of that size now. Secondly, I think our organic and retention growth rates have been exceptionally superior. So clearly that's improving and allowing us to hold on to market share. The third is we have taken market share. If you look at new accounts that contributed in group, about 11 to 12% of the premiums we serve each year have come from new accounts that came in, mostly from competition.
Okay. And you've not lost any to competition accounts?
So our retention rates are 94%, so we do lose 6%.
So the 6% that you do lose is because of?
So it's multiple reasons. One, sometimes the benefits disappear, especially in the long tail of the corporates. And two, in the past, it used to be insurers that we did not have a relationship with, in case a group moved to an insurer that we didn't have a relationship with, but that's less a problem of late.
Satish, you made 7 acquisitions in the last 8 years, 3 in 2022, you made 2 of them last year as well. Are there any more in the pipeline? Are you in talks for any inorganic growth plans that you have going forward?
So we've always been very, selective in the M&A strategy. We don't use M&A for top line growth necessarily, given our organic growth rates. So we've acquired 4 TPAs in the past, when mostly for relationships, just to accelerate the acquisition of relationships and our ability to continue to retain them. So we'll continue to be on the lookout, no specific targets or less. Our plans are predominantly like organic.
Okay, Satish, out of time. Thank you very much for joining and speaking to CNBC TV18. Congratulations on the IPO and wish you all the very best.
Thank you very much for having us.
So here's what
Thank
we'll
you.
do. We will move on and talk about